Netflix delivering a beat on its top and bottom lines just moments ago. Shares falling, though, on light third-quarter revenue guidance. Joining us is Propagate content chairman and co-CEO Ben Silverman. He was also formerly co-chairman of NBC Entertainment and executive producer of The Office. Propagate Content will release also a movie titled Incoming on Netflix in August. It's great to have you on, Ben. And what I love about having you on the heels of Netflix earnings is that you can inject some insight into the content piece of this puzzle, which we know is an area where so much spending has happened in recent years. When you look at Netflix and what's been doing particularly well, it isn't just their original content, it's also their licensed content, too. So how does it speak to the picture we're seeing and the spending landscape?
Well, I think we had a big retrenchment. We obviously had a strike, which actually delivered a lot of bottom line positive results for many of these big companies. But I think watching what's going on with the Paramount sale that'll hopefully conclude with David Ellison and Skydance is going to be really great for the content market in general, because we've had a couple of the traditional players sitting on the sidelines really cutting way too much, in my mind, because they're going to need original content to compete. And then you have other players, specifically Apple and Amazon and Disney, who are in multiple businesses that their content drives, right? The content of the services business inside Apple drives so much other business for their hardware and other elements of their company, the same way that Amazon's Prime business drives more usage and more purchasing through their storefront. And I think Netflix actually is going to be the really most pure play player in the space, and only has upside in starting to monetize their content through commerce outside of their consumer commerce and growing subscribers, but in building brands off the shows they own. And then licensing has always been part of the television ecosystem. You know, the days of hitting the holy grail of 100 episodes off a broadcast so you could syndicate your shows, which, helped me a lot in my life, now have moved into the streaming wars and the content acquisition of licensed content like Suits, like The Office, like Friends, has really driven up new opportunities for rights holders and studios that own those. But you need original content to keep the customer happy.
Okay. How does live programming in sports factor into this as Netflix begins to dip its toe into that realm?
Well, I think, Netflix is starting to look a lot like TV, right? They're starting to look like TV in general. They've got kids programming. They've got foreign language programming. They've got young adult programming. They've got dramas, comedies. And now the next piece of that, obviously, is live sports and live events. And I think they've dipped their toe in it and now are going further as they invest in the NFL and other potential sports franchises down the road. And I think that you'll see what they've done so well. We make Untold for them, arguably the best non-scripted sports documentary series in the world. And I think they've done really well with sports adjacent content. So they felt confident enough to go into live content.
Right.
And I think you'll see more of it.
So, Ben, here's my question about the business, and give me your perspective as somebody who's sort of in it. It seems like the answer on revenue to, hey, these subscription plans are high priced and these services want to continue raising the monthly fee was, well, now that there's an ad-supported version, people won't churn off of the service entirely and just come for the series that they like. They'll churn down to the ad-supported plan, and all this revenue will come in from there. But it sounds like this quarter we're hearing that Netflix has more ad inventory available than they have buyers at the prices that they want to charge. So how does this get resolved? Does Netflix have to be choosier about the amount of content that it buys, or does it have to stop raising subscription prices if the ad market goes through a slowdown?
Well, I think the market will dictate, but one of the elements is that Netflix has really kept a big premium on how they charge for ads that are very much like traditional television ads. And they'll have a lot more runway. And I heard what your teams were saying prior about, their forecast for this coming later in their life cycle. But you've got to think about scale, right? Netflix will have tremendous scale, but it's nowhere near Amazon scale today, right? Amazon scale is much bigger because of how that Prime customer is subscribing at a huge volume that they don't really tell us about. And when you think about it, when Netflix gets to 400 million global subscribers, or whatever the numbers will be based on this incessant growth they seem to be able to deliver on, they're going to be able to monetize those audiences and those consumers. And if they're trying to hold on to $100,000 CPM, cost per minute advertising, or if they're going to migrate down to 50,000, it's all found money. It's all new incremental cash for this company and for all these companies who hadn't allowed a single dollar of advertising revenue into their business. And I guess it's about the matchup for them today. I think they're probably holding pricing on the ads because they're losing the potential subscriber revenue. And once that calculus works for them, they will unlock, I think, even more value through it. Television was built to sell soap.